Last week, tech stocks stalled. Are there bigger implications of tech stocks stalling? And this leads us to the question of, are tech stocks overvalued right now? In this video, I'll be sharing with you my view on whether I believe tech stocks are overvalued and my investing strategies regarding these tech companies. Before we dive into tech stocks stalling last week, let's take a look at the events leading up to last week. In 2020, tech companies have been performing relatively better than other companies and better than the economy as a whole. And this leads to some people claiming that 2020 is the year that tech took over. And in this article by US News, it mentions that tech stocks are dramatically outperforming the wider markets in 2020. And it's not just US News. If we take a look at another article by Financial Times, they also mentioned that healthcare and tech lead US stock market since its February 19 peak. And big tech stocks have acted as a refuge for investors through both the sell-off and the rally. And if we take a look at Yahoo News, it also mentions that the tech sector has played a crucial role in the quicker than expected recovery of the stock market. And the ETF has a positive year-to-date return of 13.3%, outperforming the gains of all three major US indices. And while the virus outbreak has had a sector-wide impact economically, the US tech sector has been more resilient compared with others. And looking at this chart by Bloomberg, it's no surprise that healthcare companies have been performing the best during this pandemic. But close behind are infotech companies. And these infotech companies have been performing better than other companies in the financial space and the energy space. And these infotech companies as a whole are performing better than the S&P 500 or the US stock market. And looking at the half-year relative performance of the different sectors, we see that the technology sector has performed the best in the past 6 months. And in the 3-month relative performance, the tech sector is in third, behind basic materials and consumer cyclical. Overall, be it companies in the tech sector or companies who leverage the use of technology in their business, these companies have been performing relatively better than other companies in the economy. But there are certain companies that more so than not that we as investors and consumers think of when we mention tech companies. And these companies are the FAANG stocks. The FAANG stocks are Facebook, Apple, Amazon, Netflix, and Google. Let's take a look at how these tech companies have been performing during this pandemic period. So the first one that we'll take a look at is Facebook. So we take a look at Facebook, this was the pre-pandemic high of 224.73. And as of last week, the price for Facebook was 242.03. Facebook is up 7.7% from its pre-pandemic high. For Apple, the pre-pandemic high was 327.69, and as of last week, prices closed at 385.31. Apple has increased by 17.6% from its pre-pandemic high. Amazon's pre-pandemic high was 2186.55, and as of last week, Amazon closed at 2961.97. So Amazon increased by a whopping 35.5% from its pandemic high. And for Netflix pre-pandemic high was 392.59, and as of last week, it closed at 492.99. So Netflix increased by 25.6% from its pre-pandemic high. Google's pre-pandemic high was 1531.31, and as of last week, Google closed at 1516.85. So Google actually closed around 1% lower than its pre-pandemic high. So out of the FAANG stocks, Google was the worst performing, but overall, most of these FAANG stocks have been performing well, especially during circumstances such as this. However, as we have mentioned earlier, it's not just these FAANG stocks that have been performing relatively better than the overall economy, but tech companies as a whole that are performing relatively better, and this is evident in the price chart for the Nasdaq. The Nasdaq is an index which gives a greater weightage to tech companies. And taking a look at the price chart for the Nasdaq has been up from its pre-pandemic high, 9.23% to be specific. On the other hand, the S&P 500 is still some way off its pre-pandemic high. The pre-pandemic high for the S&P 500 is around this point here, 339.28. And as of last week, the S&P 500 closed at 321.72. So the S&P 500 is still around 5% below its pre-pandemic high. And the difference in performance between these two indexes shows us that tech companies as a whole has been performing relatively better than the overall economy. Last week, the bullish momentum for tech stocks slowed down considerably. This article by MarketWatch mentioned that tech stocks faltered last week. And if we take a look at the article, they mentioned that technology stocks weighed on the benchmark stock indexes, with the S&P 500 tech sector down 1.2% last week. And on top of that, Amazon is now on pace to snap its record 10-week winning streak, while Microsoft is on pace for its worst week since March. And Motley Fool also mentions that the S&P 500 swings from gains to losses as tech giants tumble. Apple, Microsoft, Amazon, Alphabet, and Facebook, with a combined market cap of 6.6 trillion, all finished the day in negative territory. Amazon and Microsoft were the biggest losers, falling 3%. And taking a look at the 1 week relative performance, we see that the tech sector is one of the worst performing sector in the past week, registering a slide of 1.16%. While understandably this is just a 1 week performance, and as I film this video, tech stocks have rebounded slightly, this noticeable slowdown in momentum of tech stocks is definitely something to pay attention to, which leads to the questions of whether tech stocks are overvalued and overpriced right now. To determine whether tech stocks are overvalued right now, there are a few indicators that I take a look at, and one of these indicators is the P ratio. You can check out my video over here on P ratio, on how to calculate the P ratio and how to use P ratio in the stock market. I take a look at the Nasdaq to give me a broad overview of the tech companies. So the P ratio for the Nasdaq right now is 30.05. If you take a look at the past 14 years, the P ratio has generally been under 25, right? So you take a look at all this P ratio throughout the years, the P ratio has generally been under 25, with the exception of during 2016, where the P ratio went all the way up to 104. So at 30.05, we are definitely at the upper range of the P ratio. Moving forward, I will only look to buy tech companies when their P ratio is not so high. Tech stocks as a whole are definitely not undervalued or fair valued right now. But this does not mean that the P ratio won't continue to rise moving forward. As we have seen in 2016, the P ratio can rise all the way to 104. So while the P ratio gives us a general sense of whether the tech sector is overvalued, fair value, or undervalued, we should not base our buying and selling decisions purely on the P ratio. Because like I mentioned, even though we are at the higher end of the P ratio at 30.05, the P ratio can continue to rise. That is why there's this saying that the market can remain irrational longer than an investor can remain solvent. If we take a look at earnings per share recently is $4.37. And this is near the 14-year historical high of $4.63. With earnings per share near its 14-year historical highs and the current pandemic affecting companies' earnings, I believe moving forward for the P ratio of the tech sector to fall, if it does, I'm looking more towards the fall in stock price rather than the increase in earnings per share. Taking all this into consideration, I'll definitely not be adding any more positions in tech companies. But I also won't be selling the tech companies that I'm holding on right now just yet. Even though the P ratio of 30.05 is towards the higher end, this does not mean that the P ratio cannot continue to rise moving forward. And that is why I will still be holding my positions in tech companies until the trend changes or the price action indicate to me otherwise. If you have learned something from this video, do leave a like on this video because it will help the channel grow and allow me to continue producing more content such as this. And make sure to subscribe to my channel so that you'll be the first one to receive these videos when I release them each week. I'll see you in those videos. To your financial success.